All right. We'll let some folks trickle in here from the waiting room. Hello, everyone. Thanks for joining us today as we discuss a timely topic in Q4, holiday 2025 readiness for retailers, many retailers, one of the busiest times of the year. So we have invited our esteemed godfather of retail, Mr. Paul Erickson, to run through a few best practices, tips, and tricks that we do here at M1, just to get everyone fully prepared for the rest of the year, going into holiday and a little bit post-holiday. But before I switch it over to Paul, I just wanted to do a little housekeeping on the webinar today. First things first, we are recording this and we want this to be an interactive session. So right down at the bottom of your screen there's going to be a Q&A button. Absolutely, feel free and flood us with questions. We want this to be a live session, and Paul is here to provide his decades of wisdom. So please shoot over some questions to us and we'll be happy to answer them live here. If you do have to leave, we understand retailers are very busy. We are recording the entire session and it will be uploaded to our YouTube channel after. So who is Management One? If you're not familiar with us, our main purpose here for nearly 40 years has been to provide financial security for our people, our clients, and our retail experts. And we do that with a focus of merchandise intelligence and educational sessions like these for independent retailers like you. We operate with a set of core values, and that being a generous heart, courage, curiosity, adaptability, which is huge for retailers in particular, commitment, and collaboration. And with that being said, I will turn it over to Mr. Paul Erickson. Thanks, Paul.
Thank you, Nico. And by the way, everyone that can hear my voice, when Nico called me the godfather of retail, he's obligated to do so within his employment contract.
By contract, yes.
So, yeah, so that is by contractual obligation. So, thank you, Nico. Hi, everybody. Good morning, good afternoon, wherever you are in the United States. This is going to be a little bit of a different holiday presentation for you because we're going to talk very little about this. And we're going to talk a whole lot about money. That's going to be the bulk of the presentation today. But with that said, I found an interesting statistic the other day that said that 40% of the people begin their holiday shopping before Halloween. That's that's certainly not me, but that is really true. And I've asked other retailers if that's true, and they said absolutely. People are already getting into the holiday spirit. And so, what can we do just to be smart retailers in terms of maximizing our goodwill with our customers and making sure they shop with us? Well, obviously, free gift wrapping. Make sure everybody knows that you're local. I don't think we really appreciate the importance telling people that we are a local business in shopping. Whether you shop with us, it stays in the community. Ashley Alderson at the Boutique Hub actually has a really interesting statistic about that, where for every dollar that they spend, a customer spends in your store, that distributes $7 into the community, the local community, and that's not something you don't shouldn't hide from. People, it has been proven that people would rather shop local, all things being equal, than a major national chain. So, give suggestions. We don't do a good enough job of that, I think, in retail. The product bundling is something else that smart retailers do. I am a big believer. I'm an old-fashioned guy, and I believe in blocking and tackling. And part of blocking and tackling in retail is the simple the thing of a called a thank you note. A handwritten thank you note to your customers as you go into the Christmas season really packs a powerful punch. And let's not forget the last thing is this should be, not always, but it should be fun. So generating cash, there's lots of ways. Obviously, one of my favorite is gift cards. Um, and I think we need to train our sales team on how to get gift card transactions so they're quick and they're easy. Because many times, if they can't find the right gift, a gift card can be just the right item for them. Plus, the beautiful thing about gift cards, as most of you know, is that at any given time over the course of a year, 10 to 20% of gift card balances never are spent. So it adds markup right there. Gift cards obviously are a really important thing to do. So I have now put that out of the way, and I want to get into what I really, really want to talk about today, which is something that's very important, and that is holding onto your cash. The common year-end problem, and this has been going on forever, I think. I remember when I started as a consultant, and I had a client here in the Twin City area, and the father was retiring, and he was handing over the business to his son, and he hired me to be the consultant to help his son. And the first meeting, the father came in the meeting. We were in the conference room, and he sat down, and he said to me, I'll never forget this, and this was a long time ago. He said, Paul, the retail is getting a lot tougher now. This is in the 80s. Retail is getting a lot tougher now. And I need you to help Neil and navigate through choppy waters. I remember, and this is a direct quote, when business has been so good for me that would have to go to the bank and borrow money just to pay the tax on all of the money I was making. Now, I was a young man back then, and that didn't sound right then. I mean, if you're making a lot of money, why are you going and taking out a loan to pay the tax on it? And this has stayed with me over the years. And I've done a lot of research on this, and it's a common year problem today. The cash on hand not equal to the net profit on your P&L. If you make $110,000 on your P&L, or whatever that number is pre-tax, that money or more should be in your checking account. And if it isn't, then we need to have a very serious conversation, which we're going to begin right now. Now, this is a spreadsheet that we developed at Management One, and we've used this spreadsheet for Q4 for a lot of our clients as part of the service. And it was really started because of a client that we have that's in the hobby industry who was very nervous about getting product on for Q4 this year because of tariffs. And he was advised, and I think correctly so, to bring everything in early so that you have the merchandise there to sell as you get into the Q4, which was a critical time frame for him, which is what he did. Now, that's fine, but when we got into July, he was $180,000 at cost more inventory than he normally has or had last year. This is a retailer that's very buttoned down and watches every dollar. And for him to be $180,000 over plan in LY at cost really created a nervous tick in him. It was all on credit cards too, by the way. He was putting all of these bills on credit cards, and there he was sitting there with all this inventory that hasn't sold yet, and credit cards maxed out. And so, what I said to help him, I said, let me create a spreadsheet for you over the next 3 months, October, November, December, that looks at and see what our obligations are, what we can sell realistically, where should our inventory, where is our inventory, and where should it be at the end of the year, and then how much additional inventory should we buy? Then let's look at how much our expenses are going to be. Let's look at what our payables are, and that's payables is anything that we owe, which is a line of credit, or if in his case, all of those credit cards. And let's see where you're going to end up at the end of the year. And after running the numbers, we actually found out that after everything was paid for, everything's paid off. The rent, he was buying out his father, everything. He would have over $100,000 in free cash, which which is at that point I saw him smile for the first time. But the anxiety completely went away. And our thinking at Management One is this is something that we need to offer to more and more of our clients, which we are doing. Now, what I'm going to show you right now is the actual presentation. I'm going to make it very simple, and I'm going to probably not try not to screw up the highlighter here so you can see what I'm doing. Uh, and I'm going to highlight exactly what it is you're looking for. And I think you'll find this very interesting because in this particular case, it shows this retailer exactly why he never had the cash on hand. This is another retailer that came to me and said, I would like to do a thorough review of my situation because I'm always showing well over $100,000 in net profit at the end of the year. And never do I ever see this in terms of money. And so I go, can you do this? And so we did it. And this is it. The name of the retailer shall go unnamed, of course. But let me show you exactly what this is doing because it's very simple, yet very important. The first thing we want to look at is on the 1st of October, as we enter Q4, we want to look at how much inventory do we own right now at retail. So we have that number right there. Then we go, how much business do you think we can do in October? We plug that in. And by the way, these are all the classifications. This isn't just one big number. These are all the classifications that we're looking at planning sales. So it's not, so it's coming from a bottom up approach in terms of revenue. That was October, here's November, and here's December. So roughly in this retailer, a little bit under 750,000 that we realistically can sell. And then where do we, and here's a key one right here, everybody. Where do you want to be on January 1? Now, very few retailers have this number, and it's an incredibly important number because where you end the year in terms of how much inventory is sitting in your store unsold dictates so many things in your business from cash flow to profitability to taxation. And so we've got to make sure that this is the right number. In this case, we want to have at the end of the year 725,000 at retail. We also have an open to buy. We still need to spend about 137,000. Okay. Everybody with me so far? We own 1.1. We want to end at 7.25, and we realistically believe we can do this much business in less than 90 days. To, to do that, we still need to purchase another $137,000. Now we put in all of the expenses to the right there, which is freight, payroll, bank charges, rent, everything else. And that added up for the final quarter for this retailer at $316,000. Then we want to take out what's your payables. In this case, he had a combination. In this case, this retailer had a combination of credit cards and line of credit at a bank, short-term payables. I need those paid off, Paul, by the end of the year. It's 160,000. So we've got a free cash flow of almost 600,000 in terms of free cash flow. And you subtract the expenses and subtract the payables. And this retailer should have, voila, $117,000 with everything paid off at the end of the year. Cool. Except for one thing. And those people in the audience have probably already seen the problem because there's a problem lurking in this data. And the problem is that we're $107,000 over bought for Q4 at cost. And in that $107,000 we're overbought in Q, which will eat up almost all of this. Of that, 90,000 is sitting in one classification. 90,000 is sitting in this import program. Now, the import program, in terms of profit, in terms of percentages, is incredibly profitable. He gets anywhere from 4 to 5 times markup on cost. In other words, his markup is anywhere from 75 to 80%. And after it's sold with markdowns calculated, he still maintains 66%. So, on the sales that he does on the import merchandise are fantastic. They're very, very profitable. The problem is he has to buy minimums, and the minimums are causing him to tie up the cash. Within this first spreadsheet, we immediately identified where the problem is. Now, the solution to this is has something to do with how fast he turns it over and how quick he takes markdowns. But what he can't do is he can't have all of his money, all of his profit tied up in inventory that hasn't sold, no matter what the margin is. And I found this to be a very, very enlightening a spreadsheet when it came to that. And every person we've done this to, as really they've looked at this and we've really started to use these levers. We had another client who she said, I can't afford to carry this much inventory into January. we've got to reduce my plan to get it down because there's just it ties up too much of my cash. So we started to adjust here. But this creates the overall framework around your final 2 or 3 months in your business so that you can end with the right amount of cash and know exactly where you are going forward. Now, for many, 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 many retailers, December is their best opportunity to cash flow. If we miss December, we really miss an opportunity. And so I'm going to take a look at another client of ours in a report, and I'm going to show you exactly what I'm talking about. We'll go because it's December's now or never. His December sales are 438,000, and I'm going to highlight this. His January sales are 209. He's going to do over $200,000 less revenue in the month of January than he does in December. That's a turn down in traffic and revenue that happens overnight, literally. And so it is now or never on how you cash flow. So I want to take a look at, and I showed him this. I believe he can get a $68,000 increase at the end of the year free cash. So once again, this is what makes Nico nervous because I'm going to try to play with these things down here. We're gonna look up right up here. I'm gonna make this larger.
I have faith
Okay.
in you, Paul.
Okay. Look at that, Nico. Pretty good, huh? All right. So those of you that are management one clients, you'll relate to these numbers. Those of you that aren't, well, we would love to have a conversation with you. But in 2024, this retailer was sitting with 1,079,000, and in 2025 we're sitting with 1.1. So we have more inventory here right now than we had last year, and our sales are about the same. If you can, in fact, if we can move this over a little bit, the difference is 0.9% sales are up this year. So we're doing the same revenue, but our inventory is up. Now this plan is we only last year we went for the last 2.5 months we only reduced our inventory by less than $100,000. Everybody see that? We were at 1,079,000, and when we counted on January, when we were at 961. What we want to do is get that inventory down even further, which is going to improve cash flow. And that's something that this is the opportunity. If we don't use this opportunity in December, because here's his December sales, 438,000, and here's what he did in December of 2024. And here's January 2025, 209,000. If we don't do this, then we're going to be sitting with anywhere from 50, 70, 80, 100,000 or more inventory. And that is why retailers generally complain about being undercapitalized and my cash flow is never enough. And that's because they're not looking at this hard, taking advantage of this one time frame in the year where we can really cash flow. And that's very, very important. In this case, you can see that the free cash in this case, in the year-end goal adds up to a $68,000 increase in year-end cash. Now, I know for many of you are going, oh my God, there's so many numbers. But yes, there are numbers, but numbers are important. And this is why Management One exists, because we know you're not going to do it. We're going to do it for you. We're your Sherpa guiding you through this to get you down the mountain. Like, how do you like that one, Nico? To get you down the mountain into base camp. I just made that up just now. I'm pretty proud of myself. Into base camp on January 1. Okay. Now,
Alive.
what do we need to do? We need to review, we need to do an end of December target inventory. We need that. You have to do that. Otherwise you're like just this free floating feather going around and you'll end wherever it lands. That's not how you're going to control your business. That's not how you're going to increase your cash flow. That's not how you're going to increase your sales. And remember, and here we're going to get into something that gets a little controversial. Your fiscal year ends in December. Most of our clients do. Not all, but the vast majority of our clients' fiscal year is a calendar year. And at that end of December, you are going to be taxed if you're profitable on every item you inventory. Now, I want to make this very, very clear because a lot of people don't understand this, particularly accountants. This is not in reference to what is called an asset tax, which only a very small minority of states require. This is not an asset tax. This is something far more important when I say this. And this is the actual cost of goods sold formula itself from GAAP accounting principles. And you need to understand this because it can truly help you in terms of controlling the amount of taxes that you're going to incur from the government. Look, cost of goods sold can be, it doesn't have to be, but can be the most misleading metric in retail. And when I talk about this, people go, "Oh my God, if that's misleading, that's going to mislead the entire profit and loss statement." Because if your cost of goods sold is wrong, then everything is going to be wrong relative to, are you making money? How much money are you making, or not making? So how is it wrong? And so I'm going to go through this, and I've done this many times, but I think it's so important this time of year. I'm going to go through it again. We're going to take some time about this. So let's do GAAP. GAAP means GAAP, generally accepted accounting principles of calculating cost of goods sold are: you take a store that does $1 million. You take your beginning inventory at 250, your purchases at cost 700, less your ending inventory at 350, and that gets us the cost of goods sold, $600,000. Now we take the sales less the cost of goods sold, and we get our gross profit of $400,000. Now let's take our gross profit and let's say our expenses run 350,000. Arbitrarily put those in there. And in this case, on this P&L, we would have a pre-tax profit of $50,000, which will pass through to your personal tax statement that you're going to provide the IRS. That $50,000 profit, which you will pay tax on, depending on the bracket you're in. So if you're at a 30% tax bracket, that's $15,000 you'll pay. Now, let's look at this a different way, and we'll talk about why this is a problem. What's your cash in and your cash out? We'll look at just simply cash. The cash out is the merchandise you bought last year at 700,000 plus your expenses at 350. Cash in is your sales, $1 million in, remember. But here we have cash out $1,050,000, and this is the same retailer that had to pay $15,000 to the federal government based on the net profitability of the business, but still had $50,000 likely in credit cards that they still haven't paid off. Now, how did that happen? How can we, to quote this gentleman from Minnesota many, many years ago, I was making so much money that I had to go borrow money from the bank to pay the taxes, which is exactly here. Now, how did this happen? And let's go back to the statement and look at it from the perspective of beginning and ending inventory. Because in this example, our beginning inventory was 250,000, but our ending inventory was 350,000. And that $100,000 variance or delta created a $50,000 profit, but a $50,000 negative in cash flow. So when I tell everybody on this call, please start thinking about where you're going to end the year. Where were you at the beginning of the year? And make sure that your inventory isn't ending up like in this example with $100,000 more, which is all again taxed. So that is how that happens. So what I am imploring everybody on this call to is look at where you started the year on your cost inventory and make sure and work with your accountant on this and make sure that you don't report an inventory that is considerably higher because you're going to get a bit by the tax man on that. Let me show you. Some other samples of this, and I'm going to make this a little bit bigger again. Again, Nico is getting very nervous, so we're just going to bring this up here, and we're going to take a look at a client. And this is a client that business is up 3% this year. So as of last night, we were at 787. Last year we're at 763. We're up 24,000. We're flat. We're up. It's nice to have an increase, but not by much. Sales are okay. But look at the inventory. So we got a 3% increase in sales, but look at the inventory right now. 418, last year 364. Okay. Anybody getting nervous with a $50,000 more inventory? Now it's early. And so we can still do something about it because it's still October. But we've got 50,000 more products sitting there in a business that's 3%, only 3% up. So right now, what we've got to do is avoid, in this case, what happened last year. Or because what happened last year is we started 2024 with 226, we ended at 255. We had $29,000 excess inventory, which again turned that into cost, and then that's all going to be taxable, that excess inventory. What we want to do is get that back and reduce the inventory from 418 to 218. It's our one chance the next 3 months to really cash flow this business. So let's really look at this and go, our goal is to cut our inventory by the first of the year to January 1 to $218,000. That is at retail. If you convert that to cost in this retailer, that produces $100,000 positive cash flow for this retailer that has nothing to do with profit. It's simply inventory reduction as we end the year. This is a really big number that we need to understand. And it's a really important number that once retailers understand this, it becomes a religion to them to get this thing down and to diet this thing down to where it should be. So is this retailer going to be where he needs to be? Well, we go down and we look at the negative and the positive here, and he's going to be a little higher. So we're going to have to look at this by classification. We're going to look at markdowns. We're going to have to look at what's on order. Do we need all of this $60,000 to $100,000 cost on order here coming in the next 3 months? All of this we need to look at. But we are now basing these decisions on a goal to get us to where we want to be at the end of the year so that we can all go to Nico and I's favorite place, Hawaii, and get out of the cold weather where I live in Minnesota. Okay, let's go to the next one. All right, this is an interesting one. I wanted to show everybody this because this is a client that I'm going to show you this one for a number of reasons above and beyond taxable because this is something that I see and we see at Management One over and over and over again with new clients. So let me make this bigger again, and I'm going to show. We're going to look at a couple of things on this on our plan here. So we're going to make this. We're going to go right over. We're going to go way over here, and we're going to look at. There we go. Okay. So this retailer last year in 2024, so small store, did $279,000 in sales. That was their sales they did for the entire year. Little store. I remember talking to this retailer and said, "You are in it. You have so much more you can do, but you're not funding the inventory properly. You're holding on to the inventory for too long, and you don't buy enough." In fact, by proof of that, the purchases he had way down here, where my hand is down the bottom here. Let me see if we can get that right there. That's how much this retailer bought for the entire year. I don't think that unless you're Merlin the magician, you can buy 277 at retail and sell much more than 279. It's going to be kind of hard. You have built in your sales right there. So by working with this retailer strategically, in 1 year, we have turned around not only his business, but we've turned around his life. Because this year he's got his purchases up to 448 and sales are now 423. And we knew this would happen because when you did a thorough look at how much he was buying and when and in what categories and how he was leaving himself open and missing business in category after category after category because he was being too conservative, it hindered his growth. And now we've unleashed it. And right now, if I go over to the right here on this report, we think he's at a $600,000 store in 1 year. One of the most beautiful things about retail is that, and I say this in a lot of my webinars and seminars, that a problem on Tuesday can get solved on Wednesday. And it's very, very true. Retail is one of the most beautiful professions because once you figure out Once you know what to do specifically financially in your business and what you've been doing wrong, the turnaround can be absolutely exhilarating. I mean, we're dialed in on this retailer. So last month in September, his sales plan was 51,340. He did 51,658. We are dialed in. We predicted the 46.6% increase in sales last month. We knew this was going to be. We got a little lucky, but it was pretty close. Right now, this month, he's tracking to do way up at the top 67,984, and the plan is 66,238, which that gets my way all the time. But my point is that retail is surprisingly predictable. This is not chaos. This is a business that once you know the data and once you know the patterns of your customers and how they buy and when they buy and how fast you sell inventory and how to use this information to find what can be called diamonds in your backyard. Once you understand how to use data to run your business more, there's always going to be an element of gut. Trust me. And the best retailers use their gut, but they also use data to make sound decisions. The results can be absolutely remarkable. Now, here we are sitting at 212,000. Well, last year we had 142. Of course, we're going to have more inventory than last year. We were 50%, 47% up last month. We should have more inventory, right? But now we have the right amount of inventory that's driving business in the right way. That still does not take us off the hook of what? Where do we end? And I still want this retailer to end right in this number here. We're at 116. The plan wants them to end at 105. We still want to get it down here to end, and because we still have to pay attention. Now, this retailer, no matter where they end on inventory, is going to pay a lot of taxes. And you know why? Because they're making a lot of money. They're going to make a lot of money. And we're not saying you shouldn't pay your taxes. All I'm saying is you shouldn't pay your taxes on mythical profits. This retailer is going to pay a lot just to maintain that number. We need to get close to this number right here. But I wanted to share with you this particular client. I just encountered this because I know these people. And by the way, if you can see down there, we still have actually a little open to buy here at retail. We're not actually done buying yet either. Let me go to talking about the year end. Because that point in time on January 1 happens it is coming up, particularly in December, we need a drop dead date for any receiving in December. Now, there is a date that I've often told clients that I would use, and that date is December 11th. And then, unfortunately, one of my clients realized that that was my birthday, and all I was doing is giving him a hint to give me a present. So it is my birthday, December 11th. Nico, I don't want anything outlandish from you again. Just a nice card would be nice. But we do need a drop dead date for receiving, because if merchandise is not absolutely necessary and comes in late, don't open the box. You become Sergeant Schultz from Hogan's Heroes. I know nothing that's not in your inventory. Now, I believe, and I was talking to an accountant last week about this, and she was saying that there's a way around that. So if you have a good accountant, you can still open it up, put it out on sale, but you don't have to necessarily count it. But work with your accountant on that. But that's all. Then we're all working for the same thing. We're all working for don't overstate the inventory at the end of the year. Very, very important. This is why in Canada and in the UK, they started Boxing Days. This all started in Great Britain 100 years ago, where so this isn't new, right? This is consider your start date for inventory clearance December 26th. I mean, I really think that's when you should start it. Now, in the UK and then Canada, they call it Boxing Days. It has nothing to do with pugilism. It has everything to do with they're put so much on sale that they literally, the customers would walk out, they'd have to put it in a box, the merchandise they buy. That's why it was called Boxing Days. The point of this is, and the point of Boxing Day is what everything I've just been saying. It is that a retailer can get that inventory as low as they can go by the end of their calendar year. And that's why that's happening right there. So I promised Nico that I would quote Gordon Gekko on this presentation. But you know, Everybody made fun of Wall Street when it came out because of the greed is good comment that he did. But I actually think it actually made sense. I mean, we're not talking about greedy. What he was talking about is greed is good, greed is right, greed works, you know. And greed is really all about, the greed in what he says in all its forms for life, for money, for love, for success, for knowledge, you know, and all of that greed helps us be better. And you guys all work too hard and you risk way too much over the course of the year. We worked so hard all year and with so many hours and so much risk with inventory and with debt and credit cards and juggling all of that. You do it's too you can't have too much inventory to count on January 1. It's not fair because it creates again the three problems January have sets inventory in January and creates three problems in my opinion. The tax problem, which we talked about. It's a cash flow problem. Obviously, you've got too much there. You've had to pay for it, haven't sold yet. And C, eventually, it's a profit problem because you'll have to mark it down. You have to sell it at a markdown price. So then it becomes a profit problem too. So that's the three-headed coin right there of why this is something that is so incredibly, incredibly important. So to wrap this up, don't wait until the end of the year to address inventory overages. In fact, right now is this time to start looking at it. We've still got 2.5 months to go. We have any problem can solution to a problem can happen if we know about it early enough. We should all have an inventory goal for January 1. Every one of you on this webinar, we should know where do we need to be and look at where you were at the beginning of the year. And then something around that number is where you need to be at the end of the year. And then making sure you understand how do I get there? What's my inventory? What's my sales rate? And how much more have I got coming? And is that going to create a problem? And build that cash flow projection right now. This is the time of the year. We miss this. We miss right now November, December sales. It's going to be very hard to make up for most retailers. And we got to wait another year. And by the way, getting your inventory low does create another challenge, by the way. And that is you get your inventory low, you don't want to stay low too long. So you want to make sure that all your Q1 is spent and it's shipped. Make sure that it comes in so that we're ready to go for Q1, but it's not on the books at the end of Q4. That is my wrap up. So Rico, I'm gonna open this up to a Q&A. Excuse my cough. I've been dealing with a little bit of a cold here.
There's that handsome
Um,
picture I was
I'll,
looking for. As we're opening it up to Q&A, I did want to point out to folks, Paul shared a lot of numbers, a lot of strategies, a lot about your financials. And if a lot of those had your head spinning, we actually have a couple of webinars coming up. It's a two-part webinar series about retail finances, Finance 101, basically for retail business owners. And in a follow-up email after this session, I will include registration for that as well. We've got it coming up on part one on October 30th and part two on November 13th. So if anyone feels a little overwhelmed by the finance aspect of it, we've got the perfect session for you with our partners, the CEO's right hand. So let me get into, we have just a handful of questions here, Paul. Let me pull that up. Okay. So Elena's asking if certain products are moving slower than expected, when should I start marking them down to protect margins without hurting my brand perception?
advice I give all retailers, Lana, is the best retailers I know pivot quickly. Once they know it's a problem, they do not hesitate, and they move on the merchandise right away and mark it down immediately. The faster that you can mark it down and the stronger the markdown is, the less likely it's going to linger on your sales floor. Which the lingering markdowns are the ones that create the problems, brand perception problems for you. So you want to get rid of that. I call it a cancer, and you want to get rid of the cancer right away. You don't want to have it just sit there. So once you know, take aggressive, hard, quick action and get rid of the merchandise.
Yeah, I've heard you say in previous sessions, Paul, when you talk about aggressive markdowns, 10% is not an aggressive markdown. So when you talk about brand perception, when people see a tag that says it's been marked down 10% and another 10, maybe 20, and they see those multiple red lines, that's where the
That's a
brand
horror
perception.
story.
Yeah.
Yeah, that's a that
So,
that is a nightmare. That's nobody wants this item then. So, but that is a retailer that is trying to think that they can still make money on that item. And once
yep.
you know that it is not going to sell at full price, you are not going to be profitable with that item. So you want to cash flow it immediately. I think it's important on that is that, and I've said this over and over again, it's not as markdowns are not a zero sum game. You don't just necessarily lose on markdowns. What that does is it you get the money back right away and you're going to reinvest it and something else is going to come in that's going to sell better. But the longer you sit with it and don't do anything about it, that is harming your sales big time. You're never going to maximize your revenue by doing it that way.
Yep. Oh, anonymous attendee. Okay. Anonymous is asking, what if your inventory is lower at the year end than the beginning of the year?
Ah, well, then that gives you a tax deduction. So I I had a client in Minneapolis for years, and she was a women's boutique. She was doing about 1.5 million, 1.7 million, something like that. And she would always end the year with her sale in January, and she would count like a cost inventory every year of like 150,000 at cost. And I said, you should try to get rid of this before January 1 and run the big sale between December 26th and the 1st, which she did start doing. And she started reducing the inventory. So every year, her ending inventory was less than her beginning inventory. She literally paid hardly any tax for like 3 or 4 years because that now let me under you have to understand what this means though on your P&L. When you end with less, it's going to increase your cost of goods sold. And increasing your cost of goods sold is going to lower your profit that you're going to report to Uncle Sam. That's why you're going to save money on it. It doesn't affect your cash flow. Your cash flow is going to be great, but it will show a smaller profit. So it will reduce the amount of volume. As a gentleman that worked for me many years ago once said that his dad always told him, he said, Ronnie, every now and then we got to show a profit in this business. And so that is how, this has been going on for years. I've had a client at Nico here in Minnesota. There was a franchise operation. They bought a business in Hibbing, Minnesota. The owner closed on the deal. They went into the store. They went in the basement of the store, and they had $200,000 worth of merchandise sitting in the basement that never had been counted. He called my office and he goes, "You can't believe this. There's this inventory everywhere. We didn't pay for it. It's just there." And of course, why? How did that happen? Because he was hiding it. He didn't want to pay for. He didn't want to pay taxes on it.
Uh, and do you have to pay for taxes on something like that at that point, or is it a wash?
That's a wash. That's just he could have burned it.
Yeah.
I don't know why he put it in the basement. I have no idea.
Do me a favor quickly, Paul. Can you go to the next slide? Because I have a feeling this next question may require a follow-up discussion with you. So Andy's asking, getting a little into the weeds, but Andy is asking if this is about cash flow. At what point do we look at the financials from an EBITDA standpoint and not net income?
Well, even as earnings before interest, depreciation, amortization, and I probably missed one in there too, right? EBITDA is pure cash flow. And that's actually what we are looking at. But ultimately, it's going to come out to be something very, very similar. But EBITDA is actually more of a cash flow perspective for a business. I believe it takes out amortization, depreciation, and all of those costs that aren't really a negative cash flow at the moment.
Excellent. Yeah, and Andy, if you are looking for a little more clarity on that, feel free and either click Paul's email address there. I've got a link in the chat if people want to start a quick conversation with us. But I do have a couple more questions before we end this here. I don't want to go over time. Let's see. Omar is asking, do you have tips for negotiating with vendors to create more favorable payment terms during the holiday season? Attacking it from the other end.
I think that would be something that At the top of my head right now, I don't think I can answer that today, Omar. But if you wanted to contact me, we can. I can share with you some things that some of our other clients have done over the years that have been very very good in terms of negotiation.
We did a session, oh boy, this was probably 4 years ago now, I think, Paul, on vendor negotiation. It could be worth revisiting in a future session because
Mhm.
knowing your numbers actually gives you a fair amount of leverage with certain vendors if you can really use the data to your advantage. So, just putting a quick note down on my desk, I think it's worth revisiting that. So, I appreciate that from Omar. Sophia's asking, what are some practical KPIs that I should track weekly during the holidays to make sure I'm on track with my goals?
Most important KPI, I believe, and not just me, it's generally understood in the financial merchandising sector of retail that the most important KPI to look at is something called a stock to sales ratio. That ratio of how much inventory you are holding or tied up your money and how much sales is producing. It's not looking at profitable sales, it's looking at liquidity, it's looking at how quickly you are in and out. I can tell you that when we get a larger client and start working with their actually they have a planning department. Generally speaking, their planners want to see on our report where the stock to sales ratio is because they have been schooled on financial merchandising that that is the number one metric. It's sell through. Ultimately, our business is a business of sell through, not margin, believe it or not. I'm not saying margin isn't important, but without sell through, margin doesn't mean anything. You can't take margin to the bank, so to speak. So, and so always be looking at how quickly inventory is selling. And that is the ultimate, I think, KPI, if there is one. Absolutely. If I had to pick a second one, I would look at a little more longer term. I would be looking at your cash margin. Always look at the cash margin, how much you're buying against how much you're selling. That looks at your cash flow, your immediate cash flow, and is that in sync with your profit?
If anybody has any questions on stock to sales, I dropped a quick link in chat. We got an article that explains in depth the power of stock to sales ratio. So head on over to our website and check that out. Final question, Paul, from Rachel. She's asking, how often should I update or revisit my open to buy plan during the holiday season?
Oh, uh,
I
well, Celeste would say daily, but
had, I had a feeling that would be the answer.
but I would say I would say a couple of times a week to look at it, absolutely, and see, because it's going to change very dramatically as you get into when your business takes off. If you're particularly a business, for example, our gift clients. I mean, my God, we open Nico, we open a gift store, and we look at December sales, and it's 40%. So think about this for a second. A gift store, if it does $1 million in sales, typically it'll do almost 400,000 in December, 40% index, and January will be less than 5%. So it'll go from $400,000. I don't know how much that is a day, but 400,000 to 50, 40 or 50,000 in January. Can you imagine the shock to the system relative to cash flow that is for that type of retailer? I mean, I talk about how you have to take advantage of December because it only comes once a year. But think about that if you're in a business where it is that it is it, December is that important, you have to make sure that you have the right amount of inventory that is current, fresh, and tight to what you anticipate selling so we can turn that inventory into cash.
Love it. Well, that was our final question here. I want to quickly point people's direction here to the screen. The fact that we had hundreds of retailers interested in this session alone is a testament to the fact that this is an important topic and it's something that retailers should absolutely focus on when you're looking at your numbers. So if any of this seems a bit overwhelming, go ahead and scan the QR code, click the link in there. We are standing by with a sales staff that has decades of knowledge in this. I mean, Paul has looked at these numbers all day, every day for decades. We have a very seasoned retail expert staff that can walk you through this and make sure that you are laser focused on the right numbers at the right time.
That
Paul?
and Nico, I think too often, what I wanted to do today, Nico, is really talk about what we do.
Yep.
This is what we do. And the reason why I think he's talking about if these seem confusing, it is confusing. It can be very confusing.
It's
And
a moving
particularly
target.
retailers who are normally more creatives, right? So for these numbers, they're like, my God, isn't this why I have an account? And the answer to that is no. Your accountant doesn't really do this. Your accountant reports on what's happened. We're dealing with your business in terms of what's going to happen based on all of the information that we have so that we can steer you into the right path so that we can grow our business, pay less taxes, have less markdowns, have greater cash flow, and have more financial stability and have a more fulfilled business life. That's what we do.
We're here to make the conversations with your accountant positive ones. Paul, I've missed sitting on these sessions with you, and I'm looking forward to many to come in the future.
Thanks,
And
Nico.
thank
Th-
you to everyone who joined us today. Again, this was recorded, so if anything that we went over needs a second look, or if you want to review this with your team, we are going to be sending out a recording, putting up on our YouTube channel. And again, a link to the sessions coming up on October 30th and November 13th. We will include a registration link to that as well. Paul, always a pleasure. I'm looking forward to our next session.
Thanks, Nico. Bye, everybody.